Hello, Brokers Are Better Facebook community. We are here with living legend, Gary Malice. How are you, Gary?
Yeah, I'm going to apologize first for my dress. I watched your show yesterday with Barry and Matt Ishbia, and they're in their fancy clothes and their well-polished suits, and I look like a homeless guy. You didn't tell me we were going to do this till about 5.
Let's tell everybody what happened.
Don't have your broker community judge me, please.
So I'll just give everybody a little bit of background. I was seeing all of the between email, Facebook messages, and just post in our group about the cash out refinance changes and concerns over this and not understanding what exactly is happening. So I called Gary 15 minutes ago and said, "Hey Gary, how did you feel about going Facebook Live?" And he's a good sport. He was in his car still, but he jumped on this with us. So Gary, thank you, and we appreciate you.
Look, we talk all the time. Might as well talk live on Facebook. What the heck?
Exactly. That's exactly what I was thinking. So here's my question for you is we've talked about this. We covered it a little bit in the conversation with Matt Ishbia and Barry Habib earlier this week. But, at that time, that was the day that the announcement came out from FHFA. And you and I had actually talked like an hour before then. You'd said it's going to be interesting to see how people price this because, we got a 700 basis point scratch and dent LLPA that's basically just been announced, and cash out refis are not included. So you told me then, you're like, cash out refis it's going to be interesting to see how the market responds to this. So Wells Fargo suspended cash out refis on the correspondent side from a purchase perspective. We're seeing a whole bunch of lenders react to this. Tell us what's happening.
Yeah, so you basically have two different things, and I think Barry Habib did a nice job, as he always does on MBS Highway yesterday morning, kind of walking through the mathematics. So two different things. You have the cash out one, and you have the just normal loans that are in this safe harbor zone, the expensive harbor zone, but at least it's a safe harbor zone for 700 basis points. And so every company, based on, and we talked about this on your last call, based on their cycle from when they fund to when they sell the asset to the GSEs, whether they securitize, whether they use the cash window, whether they're an aggregator, however they do it, there's this open window. And the open window for anyone that requests forbearance, and again, ignoring all the legal questions as to whether you can ask for forbearance before you have a payment, whether it's even a GSE loan, if it can't go to the GSE, you even have to give forbearance. There's some fascinating legal questions that many trade groups are gonna have to go through right now. But ignoring all that, the math is simple in some respects, right? It's how many loans in this safe zone would you have fall into this risk category? And then based on that, are you going to take that 700 basis points and fade it into your overall conventional price? The problem is, as we talked about in your last call, on the example of the $100, you have 99 that goes to GSE, 1 goes to servicing. 700 basis points is at least calculable. The problem with the cash out finance is it is now incalculable, which means you'd have to own that asset theoretically, or as they pointed out yesterday, find another buyer. Well, there is no other buyer right now in this marketplace. The other buyer is 75 cents on the dollar.
So the other buyers, like just so everybody understands, so you have Fannie, Freddie, and Ginnie, and then you have basically the aggregators. And the aggregators are New Res, Penny Mac, Mr. Cooper. These are the big aggregators, is that correct?
Yeah, well, no, I think what they were, I don't think they cared who it was, but I think they were trying to say facetiously, hey, look, you can always find someone else. If you don't like if you don't like our story and you don't like our price, go somewhere else. And I think what they were trying to say is there is nowhere else. So the point is we are doing you a solid. And again, it's all in the eye of the beholder, because one could argue if the scratch and dent market, because in this case, the aggregators can't buy it because the aggregators are going to sell to the GSEs. So to say find someone else, you can't list people like New Res and Penny and so forth, because they're not balance sheet players. They are not keeping those loans in the full $100 increments. They're selling those loans to the GSEs as well and keeping the servicing piece. So when the FHFA says find someone else, it's because their point is there is no one else. We did you a favor at 93. Now,
basically, they're saying take it or leave it, kind of.
Pretty much, yes. That would be the New Jersey way of saying it, I suspect. It may be more colorful when you do it, but yeah, that is essentially what they're doing. And it's an interesting thing because you see Calabria getting attacked pretty hard by a lot of people, which is something I would not want to do personally because he's in charge of the GSEs. So it's not something I would do.
I'm not a big fan. I mean, we've had conversations with the team at FHFA, and I think there's an underlining tone that I kind of get from like the attacks, and just as you or I wouldn't want to be attacked, I think at some point we have to have more of a rational conversation that's less aggressive. But with that said, he still is doing the things that he's doing.
Yes, and again, and he could argue that he's boxed in a corner as well, and he's doing what he is doing. He is charged to protect the GSEs, and his argument will be is I inherited this CARES Act just as you did. And
that's the point that I want to be, is like everybody's saying, pointing the finger at Calabria, but the CARES Act is what actually mandated this forbearance for all.
Correct. At least for GSE loans, ironically, not for anything else. And so that's what's even crazier is he inherited the same mess we all did. And that's why I've been, and you look at, whoever has talked, I think even the NBA, their statement yesterday was, well, it's something. It's not quite what we had hoped for. We're hoping we can still do better. But they were careful to say, look, we're not going to attack Mark Calabria and the GSEs. And I mean, and I think that's the right approach, because he didn't write the CARES Act. Congress did. And the CARES Act has some, of course, it's well-intended. Of course, it's needed. Of course, we want to help consumers that can't pay. But is it meant, as we've talked about in the past, was it meant for every consumer? Was it meant for newly printed loans? Was it meant for someone that closes today that wants a lower rate, but then asks for forbearance tomorrow? Was it meant for people that close a loan with realtors issuing out a demand that says, hey, by the way, you can close and not make a payment for 12 months? Of course, it wasn't meant for that. And in a way, you have to respect what Congress said, which is, hey, look, we trust that the people in this country will be good people and not take advantage of this. But the irony is, these are the same people that said, how did you trust borrowers in 2007 to not exaggerate their income, and then blamed it on the banks?
That's the conversation we had, is the honor system doesn't work.
No, and it's the same reason why people buy 1,000 rolls of toilet paper, and soon there'll be no meat at the stores. People hoard, and people are hoarding this forbearance in the same way. And so it's fascinating, because Mark Calabria's point, I think it's a timing issue to some degree, because the NBA, rightfully so, gets great data from all their constituents quickly. And they're watching forbearance rise super fast and almost immediate. And yet it still has to take time to wade through. So the bottom line is the industry knows what Mark Calabria may not know yet. In other words, I don't know that he doesn't think it will get to an X% of forbearance. I think his point is, I'm not going to believe it until I see it. The difference is the MBA, the people that have service loans for years, the Penny Macs, the Mr. Coopers and what have you, are like, look, we know where this is headed. We're just telling you sooner. And he's saying more of, well, when it gets there, we'll deal with it. And it's a timing issue. So I don't know that he's being wildly irresponsible. It would be better if he would say, we will deal with it when the time comes. And so some of this is a timing issue. But here,
I think the other thing is this is, we talked about the financial crisis in a couple of our conversations, and how long that took from the time Bear Stearns went out of business to the time legislation through TARP actually took place. There was a point in the interim where Hank Paulson, the Treasury Secretary, had come out and said, we're not going to do anything to help any of these investment bankers. And that was like 3 to 4 months before they ultimately went out and did TARP. So like, to a degree, I wonder, like, if he just came out and said, we're going to bail them out, and, no, don't worry, guys, everything is good, we got your back. Like, what kind of precedent does that set across the board?
Well, and that's part of the challenge. I mean, look, we went to your point about speed. We've gone from 3.5% unemployment to 20% in less than a month.
Yeah.
There's nothing in the world that models that. Not for small businesses, not for aggregators, not for the GSEs, not for Congress. Nobody was prepared for this. And so it goes to your point. Do you go too early and say, don't worry about it, everybody, I will cover everyone? And then because the hoarding mentality doesn't just end with consumers.
That's right.
Thanks. Look at some of the money that's been handed out in some of these programs to probably, you would argue, people that didn't quite need the money yet. I suspect there are businesses that needed the money before Harvard did. And so you get the timing issue of this. But back to your initial question, because I think this is, for your brokers, it's really tricky, because, again, what I hate to see is anyone get, get attacked in this kind of environment, because everyone's doing the best they can. At least you'd like to think so. And I think most are. And I think you talked about it even with your call with Barry and your wholesale. When someone's first to do something, they're also sometimes first to be attacked. And are they being too aggressive? Are they being too risk averse? Are they being defensive? Are they protecting the nest? And it's easy to judge and call everyone else when they're trying to protect their own company and their own capital and their own employees. But the reality is, in the end, it's just math. It's math, and it's cash preservation when you have uncertainty. And so when someone says, if you close a cash out refinance on normally a very stable GSE loan, which by the way is essential, you would argue, to keeping this economy flowing, because we have a record amount of equity, we have record low rates. The best thing you could have is self-sustained growth through consumers tapping into their equity to actually reinvest money into the economy and not just try to skate by, actually be aggressive in a way that's controlled and intelligent by using the equity in their home to fuel investments.
But the issue is what the problem is with the hardship for all is the Eddie Prez made this analogy the other day. Actually, it wasn't an analogy; it was an example. He said that he had a couple that closed on a loan 2 months ago, did 150 grand in cash out, 740 plus credit scores, both employed, and they called and requested for a forbearance. So during the conversation, like, well, did you lose your job? Blah blah blah, and they were like, no, but we want forbearance because we don't want to make the payments for 12 months. And even though there's no real gain for them over the course of 12 months, they can get it. And this goes to that hoarding mentality is until that's corrected, I don't know if we're going to be able to see this resolved.
Yeah, and it's an interesting, and it brings up a great point, because we've all had, I think, anecdotes like that. And it's tricky because in theory, you are allowed to ask probing questions. Like if you call me and say, I just did a cash out loan and I want forbearance, you do have the right as a servicer to say, were you really impacted by the coronavirus? You are allowed to ask some probing questions. The problem is if someone like us or Eddie or whoever, a retail shop movement, asks these probing questions and then says, you know what, Anthony, we're going to pass, no forbearance for you. They're going to go to the local paper and they're going to say in a way that says, called my servicer. I've read the CARES Act. Everyone says free mortgage payments for 6 months, but they said no to me. And so the problem is if you try to control this in a way that almost not attacks, but tries to distinguish between the hoarders and the non-hoarders and the people that truly deserve it and not, you'll be the ones that end up on the front page of a newspaper. You'll be the one that it backfires with Congress, because Congress will then go to the NBA and say, your servicers aren't behaving. You are not giving out the free money. You are withholding money. And the truth is the servicer is just trying to do is say, look, we're not withholding money. We're trying to distinguish between those that truly need it versus the ones that don't, because your act didn't do that. You didn't distinguish between job loss. You didn't distinguish between new loans. You didn't distinguish versus cash out loans. You could even have said, now cash out gets really tricky because, as you know, cash out could be $8. It could be 1% of UPB. It could be $100,000. And so there are reasons why certain things in the CARES Act weren't addressed, because they can't get that granular, because it does lead to problems. And even the NBA brought up a great point yesterday, because when something like this comes out, they get peppered with 100 detailed questions. And they're like, look, we're talking to Congress, guys. We can't get into underwriting guidelines. So, what could they have done? They at least could have said, look, if you close a loan, you need to at least be current. Or if you close a loan in the last 3 months, you need to at least have made 90 days, 90 payment, 3 months of payments or something to that effect. They could have put in some seasoning to eliminate those kind of examples, right? I truly believe the idea was to say, look, if you had a book of business for the last 6 years and customers, you have loans out there, we're going to help you. It wasn't designed for the person that takes cash out, or it wasn't even designed for a new refinance, where if you're going to take advantage of new government rates, because let's be clear, a Fannie Freddie loan is a government-sponsored enterprise. It is subsidized money when it's all said and done.
Yeah, it is.
If you're a customer and you get a 3.25 interest rate, which is significantly cheaper than any other debt you have, then the least you could do is say, I'm not going to ask for forbearance when I close, and I'll honor this seasoning requirement. So the CARES Act could have put in those kind of things. They also could have put in a sunset date, for example, because to your earlier point, when we talk about modeling out, how long do you model this out for? You take those examples and play it forward. When will they end? If there's no way to stop or know when the forbearance request will end, and it's already jumped to 6.5%, 7%, when does it stop? Because once people start seeing that it's popular and it's more common, then does that even inspire more people to say, well, wait a sec, they may run out of money. I better get mine in too. We've actually seen people that have asked for forbearance. They don't even need the money. In fact, they want to make their payment. They're just saying, look, I just want to say I'm in forbearance so I don't lose that option later, because they feel like there's a possibility of, kind of like the other money, it runs out. Like,
yeah, that's a really good point, because that is actually what we're seeing with the SBA, with the loans that for small businesses, is you saw all these companies that really shouldn't have. Well, everybody needs money right now, but like you see Ruth Chris, you see these big companies that took the money and they're giving it back, but the stance was, We don't know if anything else is coming. We don't know where we're going to be in 30 days. So we're just going to hoard that. We're going to take what we can get. And that's kind of what's happening.
Yeah, I'll give you a real live example. So even with Ginny, look at the PTAP program. Now it talks about last resort. Now it does take out the default language, which was great. Ginny's been terrific, right, in so many ways. But they're a government enterprise too. They have limitations and they have some rules. And so one of the big debates has been, well, if you ask for the money, what if you don't need it? And they're like, because what does last resort mean? What if you may need it, but you don't know where margin calls are going to be next month? You don't know if aggregators are going to buy loans. You don't know if you're going to get stuck with some cash out loans that now you got to pay in full. And so your cash situation has changed. And so you have to, in theory, ask for money based on some grand design that you think may happen. But if it doesn't happen, then you get accused for asking money you didn't need. Or if you don't ask and then you do need the money, you don't have the window in time to ask for the money. And so what people forget is how complicated it really is to do the right thing, even if you're trying to do the right thing. And that's what I think is frustrating for this industry is even for those that are trying to do this right, change guidelines here, change guidelines there, ask for money, don't ask for money. Whatever you do, you get accused of being too weak, too strong, too aggressive, too defensive. You can't win because everybody Monday morning quarterbacks any move everybody makes. And they're mostly, I believe, all well-intended. And some of it's just a timing issue.
So, the only way to correct the forbearance for all hardship requirement is through legislation at this point. That's my understanding. So because it was done through legislation, it has to be corrected through legislation. So the question I have for you is, what can FHFA do that would really be the immediate fixer, not fix the servicing problem, because I think that's a TBD at this point, because we don't know how big it's going to be and how long it's going to go for. But what can they do?
Well, again, you get into a real complicated, again, you get people like Dave Stevens and others that are much more connected as it relates to political issues and so forth. Look, I'm a simpleton out here just trying to basically make sure our edge is correct, quite frankly. So I'm not the best person to ask, but as I best understand it, the challenge is, and to your point, yes, this is a congressional act, and the FHFA is stuck in the middle to some degree. Now, that being said, that's a political appointee, and so I'm sure he has to tread lightly as well. And so what can they do? Well, the challenge comes down to, does Fannie and Freddie want to risk running out of money and having to tap into the money they have available, but then that gets in the way of the grand designs of then moving off privatization? And so the problem is, what becomes more important to them? This administration, as best I understand it, has pushed very hard to free Fannie and Freddie and rid them from government need. And so the problem is, I'm sure they're reluctant and resistant to want to tap into the money they have available, because then that kind of sells the narrative, oh, they really do, and they are a government enterprise, which is why if you listen to some videos, and I think KP's done a great job and many others, is we say, yes, they are, and they ought to be, and they should stay one. And this is precisely why, because the backing of American taxpayers and this fiscal stimulus and all the things we're doing includes housing, which is probably the most important sector of all right now to stabilize. And so I think first they'd have to abandon the narrative that they'd have to resist the desire to use the money that's available to them and say, yes, we are a government entity and we're going to stay a government entity and we're going to have to embrace that. But again, that's a political story that is probably difficult, because it's one they've been trying to get away from since the crisis in 2007. And so in my mind, what can they do? Look, to me, this still starts with Congress. It starts with changing the rules, but easier said than done, because Congress does things that I think in the end, they don't get into the weeds. And so they don't think through sometimes good ideas with bad consequences.
And the reality is, this is not going to be a sexy political move, because realistically speaking, it's a election year, and who wants to be the legislator at this point, now that they put CARES Act out there and they screwed over basically the banking system? Who's going to vote for, oh, let's put hardship requirements on there, because then it becomes this whole other political game. So it's really a dicey situation.
Yes, there's a lot more people that pay on the mortgage loans than work in the mortgage space. And so this is why this comes down to, when you create a disruption that leads to such a fiscal imbalance between mortgage and bondholders and servicers versus payees, and leave this huge deficit of $50 to $70 billion with no desire to cover the delta, it causes a fundamentally huge problem, which, again, has to be covered in theory by the government. And so if you create something, you have to be willing to solve for it. And it's tricky, but it's not the FHFA on their own to solve for it. And so did the hit have to be that big? I would like to think that was the first attempt. And the cash out one actually defies logic to me, because it's actually, that one is such, I think, a misfire, because one, the CARES Act didn't exempt them. In other words, if they wanted to exempt the cash out loan, then the CARES Act should have said, we're going to carve out cash out loans, because then the GSEs could have said the same thing, because then you wouldn't have been able to, then you would have been able to freely not give forbearance for cash out transactions. Right? And so that would have solved that. And so, look, I don't think these need to be major hits. If you want to say, look, because the truth is, it is not, when you talk about the 700 basis points, look, it's a horrible headline. It does seem pretty draconian. But the truth is, it goes back to our initial conversation. It's still about the speed to purchase. If we can get people to understand that when they fund, and some of this is just your broker community, it's the independent mortgage banker, it's the Mortgage Bank Association, convincing consumers that says, look, if you do a new loan and you are quick to go forbearance, understand the pain you are creating for everybody. Now, will they really care or not? And it may come down to a legal decision. It may come down to saying, look, we don't believe, if it's not a GSE loan yet, you can't have forbearance yet. But here's the challenge with that, is if you send the loan to the GSE anyway and say, hey, they're not in forbearance yet. Yeah, they called, they mentioned the word forbearance, but they're not in forbearance because one, it's not a GSE loan yet. We haven't sold it to you. And two, they don't have a payment yet, so there's nothing to forbear. You could try to make that legal argument. But if Fannie then later has a loan that you're servicing and they see it went into forbearance after they bought it, and they say, hey, wait, we went back and looked at the notes and said, they called you 4 days after they funded, you didn't give them forbearance, we're going to call that a repurchase. And that's where you get into the next issue, which is, even if you think you've solved the momentary liquidity issue, you still may end up in a legal fight. And no one wants to be in a legal fight with Fannie or Freddie. Moreover, no one wants to, I'd say, split hairs on a legal debate with the GSEs. Right?
That's not a long-term winning strategy, period.
No, of course not. It's a horrible part. And it's not a way you would do things with a partnership. You wouldn't say, well, you know what? I think I've crafted a way to cover my behind for the moment. So I've solved my problem, but I realize you may not like the way I solve it, and we may come to blows later. That's not an intelligent design for anybody.
Right.
And so we are hoping that with the MBA and everybody else, that there's some slight tweaks to the hit. And so if you do model in a few basis points, because the truth is, it's not as if that many loans from funding to request for forbearance should be that high. If we've done a good job educating, which your group has, and so many others have tried to convince, and again, it's not wrong to share with consumers, hey, look, this was meant for people that lost their job. And to be clear, there could be some ramifications for you down the road, not credit ones in terms of late pays, but you will run the risk of not getting a refinance when you want one. And if rates do drop, and if you look at most forecasts, if you combine where we're headed for recession and where rates are being kind of held back, as you know, we've talked about, people are kind of hoarding cash. They're not putting all the screen price. There's almost no servicing value. And so rates don't even have to move much for rates to improve 6 months to a year from now. Refinances could be ginormous next year. And so the people that ask for forbearance prematurely, that maybe could have got through it, they will regret potentially, unless the government comes and creates kind of one of these special crafted programs for forbearance clients, they are going to miss an opportunity later. And so there are legal ways to educate a consumer in a way that's pro-consumer, that shouldn't land you on a headline of being anti-consumer or being not supportive.
Right.
And those, I think, help. And if you can reduce that window, feathering in 700 basis points on 500 loans, or a 1 per 500, is much different than 1 per 15, 1 per, right? The cash out one is more problematic because now that's not 700 basis points. It's incalculable because your drop from a GSE is to a scratch and dent environment, which is almost evaporative right now.
Right.
That exists. And so you'd have to hold that loan, which then if you have to hold that loan, as we talked about, typically people finance loans for 90 days, 60 days on a 98, 99% level. You do it at zero, you have taken all that cash that's used for paying your brokers, paying for growth, paying your employees and so forth. And now it's stuck into a loan you can't sell to a GSE.
And it's no longer part of your leverage ratio. So
correct. It causes all kinds of issues. And that's why you saw the immediate reaction on the cash out from some. And particularly from the aggregator side, as we talked about, it's always going to come from aggregators first. It doesn't make them bad guys. It doesn't make them draconian. It's because their cycle is much longer. And because of that, their risk is much greater that they don't have the ability to put it into a GSE. companies like us or other companies, there's many like us out there that sell to the GSEs directly, but we're on the front line, which means when we fund, assuming our cycles are quick and responsive, we can get a loan in and out within 6 days, right? Literally 4 days if you're really 3 days. You can anywhere from 3 to 6 days. So the window of someone asking forbearance, to your point earlier, will there be that one? Yes, there probably sadly will be. But it's not going to be 1 out of every 7 loans, right? I mean, that would be preposterous, right? And if it was, that would just show you how disastrously bad the CARES Act really is.
Yeah. So I know you have a meeting here in 3 minutes, so I don't want to take you offline for that. But this is
they can wait. It's all about you. They can wait.
All right. Well, I would say the from an outlook perspective, knowing that legislative adjustments are probably not going to happen, here in the next 30, 60 days. What is the outlook for the next 36 days? Seeing what's happening with, the pullback in cash out refis, seeing what's happening, some lenders pulling back on government lending. What do you expect the outlook to be for the next 30, 60 days?
I think it's going to be all over the place, Anthony. That's part of the problem. You've seen some people snap really hard to the conservative, but now have actually softened up. You've seen some almost embrace people that relied on aggregators for so long, as they should have, and really would still like to, but really can't because the modeling doesn't work because their cycles are so slow. You've seen people kind of embrace servicing that haven't serviced before, but there's some issues there because if they service for a long period of time, they may have some cash constraints, so they may have some volume constraints. And so you're going to see all kinds of reactions depending on what their cycle time is, depending on what their appetite for risk is. And I think the cash out one is the trickiest of them all. I think the 700 basis points, while again, headline, it looks ugly, it's not a big parts per million. And so I think for the people, the wholesalers, brokers, I don't think you're going to see conventional pricing get significantly worse as a result of that specific instance. Right. In other words, it was already tricky enough because you still have all the other things we've discussed. You still have forbearance for all. You still have cash advances. You still have 4 months, even though it's not 12 now, it's still 4. You have PI for 12 months. You still have a million more things that need to be worked out. And so servicing values, and not to mention, as we just talked about, rates may drop. So now you have the other shoe to drop, which is even if you get through all that, well, you have a prepay speed issue. So who wants to pay a whole bunch for a servicing piece? So conventional pricing is still going to be tricky because it's still going to trail what an MBS price probably in a normal environment would. I don't think the 700 basis points is going to destroy conventional pricing. I think it's a headline story and it looks a little draconian. But again, for people that fund quickly and efficiently that are working with the agencies, it shouldn't be that big parts of a million. It certainly won't help improve conventional pricing, to be clear. It will certainly retard the process of it improving faster for the broker community.
So basically, I mean, until we get really straightforward, FHFA comes out with a policy that really clears up this issue, it's going to be a lot of the same. It's going to be, volatility, inconsistency, and to a degree, a lot of uncertainty until we get, things more stabilized.
Sure. And you're going to see every lender still play with capacity. I mean, there's still capacity constraints. I mean, there's still record volume out there. There's uncertainty. There's questioning in your modeling as to not just what forbearance is going to be, but after forbearance, is there going to be payments after forbearance? What is the performance going to be? Meaning, are you dealing with delinquent loans? So you have people still trying to scramble to build all these incredibly complex algorithms as to what percent is going to be forbearance, what's going to be my cash advance rate, what is the forbearance going to be? Is it going to be a secretary loan? Is it going to be a recast? Is it going to be a cap and extend? Is it going to be a modification? When am I going to get my money back? So you have all this modeling on both Ginnie and conventional. And because it's on future business with not great data as to what has happened in the past, because we never had anything like this, no two models are going to be universal. And so you're going to see, I think, still wild swings by everybody. You're going to see people, I think, have a model, and then they're going to change their model. All of a sudden, the price is going to change because they're going to say, wait a sec, hey, we changed our model. Look at this. And it may change either direction. And so, yes, I think sadly, you're going to see irrational pricing for quite some time. And it won't be any one thing. And literally the world wakes up tomorrow and Congress rewrites the CARES Act. There's not going to be one big thing because no matter what changes, every company still has their own issues to deal with as to their own interpretation as to the performance of these loans, their own interpretation of when these loans will go in forbearance, when they'll come out of forbearance, will they pay out of forbearance, will they pay off, will they refinance? You have, when you think about it, we've talked about this in the past, Performance, prepay speed, your two biggest things, and they are so wildly unknown right now. And that doesn't even include the complications of all the cash advances, because now throw in the forbearance piece. And so it's completely normal to expect abnormal right now. And
that's pretty much a little bit of what Matt Ishbia said the other day during the interview. Is he kind of said, I asked the question that a lot of brokers have asked, me, is like, when are they going to normalize? When is everybody going to normalize? And his answer was sort of like, when we see, less than 4 million people losing jobs every week, it's very hard to, be normal in an environment where 4 to 6 million people are losing their jobs every week. This week was supposedly a win, and 4 million people lost their jobs. That would have been the most ever to lose their jobs in a month. So
it's amazing what we get used to. That becomes, we almost, you get anesthetized to something that is bad news that used to be some of the worst news you've ever heard. Like, it's almost hard to appreciate 20% unemployment. The majority of people have not seen it. In fact, almost anyone our age has never seen that.
That's right.
And
so for you, I mean, I guess it really comes down to it's a week-to-week game. Obviously, NBA, from a legislative perspective, there's a lot of efforts being made to hopefully bring some clarity to the situation. But it seems as if the issues are, being fixed incrementally, and it's going to take time for us to see the one-size-fits-all, fix happen.
Yeah, and I think the expression you're hearing a lot of the last few weeks is this has been a tough year this week. And that's pretty much what it feels like. It feels like every week is a year. And you got people grinding, literally 20-hour days, and trying to sort through this and trying to help educate each other to come to mutual understandings that we've talked about between the consumer, between the broker, between the independent banker, between the commercial banker, between the lobbyist groups, between Congress, between the GSEs. You got 7, 8 different groups that somehow have to figure out together in a week's time 7 years of unknown data they've never seen before. And it's very difficult to do. And so, and there's no universal model that we can subscribe to, right? There is no one path to say, here's how you should model out your book of business based on your cash, your volume, your capacity, your modeling as to who's going to pay, who's not going to pay, how much FHA you do versus conventional. You look at the forbearance rates, even look at Delta. GSEs, part of the issue is, I think when people yell forbearance, they're usually giving total numbers. The GSE's numbers are always going to be less because government's going to be typically, you can assume 2x, right? And so you look at forbearance for government, it's going to be 8-9%, could be 10, could be 12, could be 15. Conventional probably may run 7 or 8, but depending on which you do, depending whether you're MBS, depending on whether you're a cash window. So there's so many different variables that every company, even if they have some universal solutions, is still going to impact every company differently. How they execute, whether they're an aggregator, whether they buy and correspondent, whether they're wholesale, whether they're retail, you're going to have different rules for different people because the cycles are different. The assumptions are different. The math is different. That doesn't make them pro-broker or pro-retail or anti-this or anti-that. It's different math because there's different speed cycles and there's different capacity issues. And people say, well, maybe you're quick to change pricing here. It's like, yeah, but am I doing you a favor if I take in a loan and I keep it for 97 days? And you're like, I could have gone somewhere else for a quarter worse. And you know what? I'd have been closed and done. Right. And there's the whole debate about when are you doing someone right? And are you hurting them more by putting a good price out and giving, what is substandard versus good service levels in an abnormal time?
Well, I think we're even seeing that right now is like, there's several lenders that, there's a lot of lenders actually that eliminated forward locks on refis, and that both wholesale and retail have done that. And if you did a cash out refi application 3 weeks ago and you couldn't do a forward lock, and here you are getting ready for a closing, and all of a sudden that program is no longer available to you by that lender, or the pricing's gone substantially worse. It really, it becomes one of those situations where, you kind of appreciate locking in the guarantee, taking what you can take, and calling it a day.
And that's another great example of when people say, hey, why didn't you take in locks? Was it because you were trying to cut down on margin calls? Was it because you were trying to cut down on volatility? Was it because you're so afraid of guidelines, you didn't want to give a commitment because you saw this coming, right? All these reactions people do, it's hard to accuse any one of them being good or bad, right? Because there's pros and cons. There's also disadvantages to not taking in locks, right? There are some challenges, or some people have offered longer locks, as we've discussed. Some people say, I'll give you 60 instead of 30. Well, if rates improve, that 60-day lock is actually more expensive. But at the same point, you're taking out coverage in a further month where you at least have uncertainty now because you've taken out the trade and you don't have to worry about rolling the trade. There's so many different issues and so many different strategies, and none are right or wrong. They're just different.
Yeah, it's risk tolerance at the end of the day. I mean, and some people right now, I mean, I've seen people that have been, a couple of weeks ago were really aggressive when other people cut back, and those people have since become very conservative because, obviously things have not just, simply bounced back the way they probably thought it was going to bounce back.
Yeah, and that's correct. Some of it is projecting changes and thinking what would happen. Some people didn't, people are trying to outguess what the GC is going to do. Some thought it could be worse than this. Some could be better. So based on then what someone does, then the story may change. And to your other point, it becomes a capacity issue. You may be aggressive and turn the water on and the faucet starts coming out and then too much water comes out. And if you've underestimated how much water comes out, the tub fills up too quickly. Well, you got to slow it down, even if you want more. And so you're seeing people move, not just risk tolerance. It becomes a regulation as to how much capacity you can do. And because everyone's moving differently, when you move, if I zig and someone else zags, I may think, oh, you know what? I wanted to catch whoever. I'm behind them today. So tomorrow I'm going to get a little better. Well, let's say I get a little better and they say, oh, wait, we got too much volume yesterday. You're going to get a little worse. It's like this game of you're not moving with MBS. You're not moving really in normal cycles. And so nothing is predictable. So you may think you're trying to get 100 million of locks a day, 500 million, whatever your target is. You may get half of that and then you adjust. The next day you may get 3 times more than that. And so that's the problem is it's very difficult to model out because everyone is zigging and zagging at different times based on their own cycles right now. Whereas
especially in wholesale, because in wholesale, as a broker, it's one thing if you're retail low and you adjust things because most of those LOs aren't sitting there with their pipeline able to move it, loans. But in wholesale, it is one of those things where today Home Point backs off of cash out refi, UWM backs off cash out refi, but Cardinal turns on cash out refi. Well, they're going to get flooded because brokers have that ability to,
yes. And let's take that example, and play it out forward. Again, I'm always afraid to use names, but use those names. That's fine. You get 2 big, great wholesalers like Home Point and your wholesale. And you have Cardinal, another great one, not the same size, but a great company. So let's say they say, hey, we're going to do cash out. And we're going to say, you know what? We'll probably only get 1 for every 10 loans we get. Well, let's say in your example, your wholesale and Home Point turned off unexpectedly. And the next day they get 700 of them. Well, they didn't model in 700. Now, if that 700 can't go to the GSEs, now what happens? And so everyone's model can break in wholesale almost instantaneously because the brokers are so quick and so intelligent and so massive now that they can basically overrun anybody. And the way you guys disseminate information now is so incredibly real time that one person is left out there, you guys are going to find it immediately. And
it's true. It is true because I could tell you and the other thing is with UWM, they were at 35% market share in Q1 or 38% market share Q1. For them to be now maybe, 20%, let's just say they're down to, 15 to 20% or something like that because of where they're currently at, that's dumping a lot of capacity into the market. And what I'm seeing lenders that I never even heard of in wholesale pick up volume. You're talking about these very boutique, regional, lenders that are picking up volume, being opportunistic, which is part of the value prop of being a broker is having this flexibility.
Correct. It's both a pro and a con to some degree because it does mean you got to rely on a new, some of them have been such reliable partners for so long, but they have capacity issues or again, maybe they're a little more aggressive on their stance. So you find someone new if you don't want to walk away from that business. And you've done a great job of trying to tell people, look, if you want to do everything, you're going to have to pick up some new partners. If you want to stay to your core business and walk away from some business, you can stay with your partners. But there are going to be people that try to pick up these I know your boutique's a good word. They're going to pick up some of these tail pieces. But boy, if they mismodel that, particularly if they're smaller, you got a world of hurt coming.
Yeah, that's true. It's 100% true. And that's the thing is, right now, I would say, I question whoever's at the top of Loan Sifter. Like people always ask me, they're like, "Oh, this person."
You and me both.
I'm like, listen, I mean, realistically speaking, if you're at the top of Loan Sifter right now, that's not where 6 months from now we'll look back and see if that worked out well. But Gary, we got 45 minutes out of you. We appreciate you. This is all the information that everybody wanted. A lot of great feedback, everybody. I love Gary. Love the Mets hat. A lot of you got more basketballs in the background than Matt Ishbia did. So we
yeah, he's a better player than I was. I might have had a better coaching career than he did, but he's a much better player than I was.
That's awesome.
I have some trophies on the coaching side. I do have that.
And everybody, if I actually saw one episode last night, first episode, Plot Against America. Gary's son, Caleb Malice, is one of the featured actors in there. So if you haven't watched that, it's on HBO. It's about 3 or 4 episodes deep now. And it's a great show. So check it out.
All right. Thanks for having me. Appreciate it as always.
All right, man. Have a great day.
You too. Take care.